Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by Ben Gagnon. He's the CEO of Bitfarms. They just came out with Q1 earnings, and we're excited to talk about the results and outlook for the remainder of 2025. Before we get into it, take a second, hit the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join, and let us know in the comment section below if you're currently holding shares of Bitfarms, what you thought about Q1 earnings, and your outlook for the remainder of the year. Now, with that being said, let's get into today's video. Okay guys, so that's right. Today's interview features Ben Gagnon, CEO of Bitfarms. This is going to be an interesting one following up on Q1 earnings, but there's a lot more going on at Bitfarms looking forward into 2025. Ben, thanks so much for making the time today. Really looking forward to this one.
Yeah, thanks for having me, guys. Always a pleasure to be on.
Great. So the standard question here, Ben, you just released Q1 earnings. Can you give us some of the highlights, key takeaways from that 3-month period?
Yeah, I think the big thing to take away from Q1 is that we really set a really strong foundation for this company here. We grew our exahash about 50% in the quarter. More or less completes all of our Bitcoin mining growth initiatives. We've got about 95% of our Bitcoin miners installed right now. So the last few miners are going on rack and being energized this quarter. And what that means is that as we're looking towards the future, we've got a really stable Bitcoin mining business that we're building on top of that we can rely on to, fund the operations of the business, fund any debt service that we have, and really enable the team to focus on the HPC development story that we're working on now and all the different activities that we've got in the US with HPC. So, we set out to do a bunch of things in Q1. When Q1 was supposed to be a foundational quarter, right? We wanted to kind of get rid of or divest the Bitcoin megawatts that we still had left to develop. And we wanted to acquire the HPC megawatts that we really thought would be kind of the flagship BTC or the flagship HPC megawatts in our portfolio. And, we got done exactly what we wanted to get done in Q1 to set up that really strong foundation for this year.
Instead of looking at the valuation of Bitcoin dropping during that course period, which affected many of the miners that had a hodl, obviously your margin 43%. On the face of it, sounds reasonable. As we were 3 years away from another halving, it looks like it's this industry is starting to look like it's becoming more challenging with the amount of results that have come out already. We've only got literally one miner who's been able to actually achieve a profit from mining. How do you see the landscape over this next 3 years as we approach the next halving in terms of energy prices, in terms of hash rate, in terms of mining metrics, efficiency of miners? How do you see the landscape over this next period now? Because at the moment, this is just sort of core business.
The view on Bitcoin mining has actually been the same. It's been for a long time. For the last couple of years, I think since at least 2020, I've been saying that Bitcoin mining needs to go to a marginal cost business, right? It needs to be this business that really gets integrated in infrastructure in a way that it's absorbing something that would otherwise be a sunk cost, or absorb as something that would otherwise just be completely wasted. Because when you don't control your revenue, the emphasis on controlling your costs is, exponentially more important. And the only way that you can really guarantee that you're going to be good, in perpetuity forever is if your input is zero or even negative, right? And that could be done with things like kind of heat as a service, or integrating the Bitcoin mining into infrastructure, especially on the distribution and transmission side. So you're just trying to absorb kind of like that gap between electricity supply and demand. But as this business continues to evolve, it's going to continue to get more competitive, and I think we see that starting to play out here. A lot of these growth that was done that wasn't really focused around how do you drive your costs as low as possible? And by that, I don't mean how do you drive your efficiency as low as possible, but how do you drive your energy costs as low as possible? It just doesn't seem like it's going to be sustainable, past this next halving. This is probably the last run for a lot of these electricity contracts because it's just going to get increasingly more competitive.
Yeah. Is there an opportunity, and tell me if it's expensive. I'm on a panel in Vegas discussing heat, how heat can be used to get further revenue. Is there anything from, I mean, you've got 15 sites mining Bitcoin at the moment. Are there any opportunities of using that heat resource to achieve any further revenues? Or you think actually the setup cost of doing it and managing that would outweigh the benefits?
It's a great question, something that we've been working on for a while now. We think that there's a lot of economic value in the heat, but the challenge is how do you match where the heat is generated with the demand, right? Because let's say you want to do something like a heating distribution for a community, a city, or something like that. The amount of steps that requires from, so many different people, so many different regulatory authorities, the amount of investment, the years that it takes to kind of build out this infrastructure if it's not already there yet, it's not happening before this next halving cycle. And so if you're not able to tap into existing kind of heat distribution infrastructure, then you need to find a customer that you can bring to where the heat is being generated. And that tends to be a bit more challenging. We've actually been working on a pilot project in Quebec where we have found a customer who's coming to our sites. They're using the heat at just one of our locations to test it out, but they're using it to dry out wood, and it's going down from, if you're going to dry it out in open air, it's going to take about a year to dry out that wood. In one of our facilities, it dries out in 8 hours. So the amount of time that you save, the scaling up that you could do of that business through this heat, is quite powerful, and there's good economics behind it that could reasonably pull down that power cost quite a bit. But can it scale? Can it really be predictable? Can you find enough customers for your sites? That's a bit more of the challenging. It definitely works in terms of the engineering. It definitely works in terms of the math, but can you pull all the pieces together and actually make a business out of it? This is the more challenging side of things. I think one of the interesting areas for us is at the power plant, we are the customer for the heat. So at Panther Creek, we're working on a couple of different pilot projects. We've identified 4 areas where we could recycle the heat back into the power plant itself. And so here's an area where we have an inbuilt demand for heat. There's a lot of things at the power plant because it's all based on heat, where we can recycle this heat for greater efficiency, for greater output of the power plants, for cost reduction, to reduce kind of forced outages, to reduce maintenance. There's a lot of benefits associated with doing that. But as far as I know, no one's actually done this before. I don't think anyone's ever integrated the heat from a Bitcoin miner into the power generation facility itself. So, there's a lot of engineering involved. There's a lot of steps to do, and we're taking our time to make sure that we do that right. But that's one of those few instances where it's easy for us to match the demand for the heat with the generation of the heat because we own both sides of that coin.
In terms of your background, which is pretty much second to none in Bitcoin mining at the moment, you're one of the sort of the OGs from that particular industry, and you were one of the first members of the Bitcoin Mining Council with Michael Saylor sort of heading up that group of mining directors and CEOs and senior management teams to discuss the industry itself. The part where we said, you don't think it's going to be sustainable through another cycle. Is there sort of like a view to, for some of the mining CEOs to get together and discuss, what happens to Bitcoin mining, what happens to Bitcoin itself? If the miners aren't mining, does Bitcoin fail or does Bitcoin still carry on? I mean, the reason we have miners is because you're there to make sure the blockchain's audited on a 24/7 basis, all the transactions, as well as achieving the blocks, but you're there to provide the audit trail. So what happens if the mining companies don't continue this? Where do you see it going after 3 years?
Yeah, well, to be clear, I do think Bitcoin mining is continuing on well beyond this halving, but the way that it's going to work and the kind of businesses which are doing the mining are going to look completely different, right? We've seen this happen every single halving epoch where the cycle changes, the cycle matures. the way that people actually operate these facilities, the way that they build them, how they, power them. They keep changing constantly with every cycle. And it makes sense because the underlying technology is changing, the underlying Bitcoin demand is changing, and the world is getting increasingly more open to Bitcoin, right? And so we're able to do things now with Bitcoin mining that we were never able to do 10 years ago. To think about, hey, we're going to be doing energy demand response programs 10 years ago was kind of a crazy thought, right? But the world's going to continue to change, and it's going to continue to evolve. I think Bitcoin mining is going to get integrated in with energy generation, distribution, and transmission. And I think it's really going to be driven by people who have something kind of that they a waste that they want to absorb and monetize with Bitcoin mining. And if you're talking about monetizing a waste or a sunk cost, then what happens is that the efficiency of the machine doesn't matter anymore. And you can start buying really cheap machines, and you can start being really, really profitable with good paybacks. It's this challenge where you've got to pay for a high efficiency machine, and you can't justify the premiums on the high efficiency machines because of the energy costs that you have going into it. So what it's going to look like is going to be, I think, completely different in 4 years time. It's going to look even different from that in 10 years time or 12 years time. But I think it's going to kind of go back probably more to what Bitcoin looked like 10 years ago with a lot more private companies. And I think maybe this is probably the last halving cycle where the public sector of Bitcoin mining is really going to be growing or increasing. And I think next sector, it's probably going to be even if it's not this sector, it's probably going to be contracting and going more towards the private companies, or it's going to be going into public companies where it's not their core business, but it's a really small part of another business, right? How can you use this to offset 2% of your losses in a business, right? Like it's going to go towards things like that. And I think the infrastructure that we saw here in Ethiopia with the Grand Renaissance Dam, I think that's a really good example of this. It's like, hey, how do you actually integrate Bitcoin mining into a business model here that's going to actually bring down what should be a multi-decades payback period by several years and overall improve the return on invested capital? But clearly, it's not like Bitcoin mining is going to consume anywhere close to 100% of the energy out of that dam, right? I mean, it's huge dam. It's going to represent a smaller percentage of it, and it's going to be there absorbing what would otherwise be wasted electricity, and that's why it's going to be really interesting.
Would you say treated as a service that brings in not the full margin, but a contribution towards margin, where you've got other services maybe that the company are now focusing on that deliver the profitable services, but they can still maintain a mining service because it brings in a contribution, and so you're basically covering your core costs, not necessarily covering all the overheads. But if you stopped it, you'd still have to pay the overheads effectively. So you're bringing in a contribution towards that. Is that I suppose
Yeah, I think it's going to be. I think it's much more interesting to say, hey, how can you integrate Bitcoin mining into like a power plant to monetize like the 2 to 5% of excess capacity and wasted infrastructure and wasted electricity that might otherwise be produced or underutilized to improve the overall economics of the business, as opposed to let's build a brand new power plant that will be 100% geared towards Bitcoin mining, right? I think it's that diversification which is really going to dominate the landscape.
And the fact that we're seeing potentially mining machines coming out maybe in early 2026 at the sort of maybe 5 or 6 joules a terahash doesn't really make that much difference in terms of the fact that you've got to invest in those machines and then sort of like deliver return on that investment and then deliver return in profitable services at the same time.
Yeah, I don't think it will, because the efficiency of the machine is what drives the price and the premium.
Yeah.
And this is a view that we've had at Bitfarms for many, many years. And it's that we don't actually want to buy the most efficient miner because we don't think that gives you the best ROIC. We actually want to buy kind of like one step down from that. And when we did the analysis of all the different Bitcoin mining purchases, investments that we've done over the last few years, it wasn't the most efficient miners that we purchased that had the best ROICs. It was often the lower tier miners that we got at a steep discount that we were able to really, really make the most money on. Like for instance, in 2020, we had a bunch of M31S that we purchased, and actually the M31S paid themselves off. I think it was upwards of 8 times over. The M30s paid themselves upwards of 5 times over. But then we also bought a bunch of S9s for $20 a piece. And then we were selling those for $300, $400, and they were already delivering, contribution margin, until the point that we sold them, right? So the lower actually you go down that stack, the more money we made on a percentage basis. But, there's this balancing act here where you're either trying to make the most amount of margin or the most money per unit of megawatt hour, and that's something that you can try and optimize for, or you can try and optimize for ROIC, but you can't do both, right? You have to pick a lane and you have to focus on one or the other. And I'm not saying which strategy is best for, any particular company or particular strategy, but, they're mutually exclusive, those two different objectives.
Yeah, and mining machine costs in reality are actually cheaper in 2025 than they were in 2021 per terahash. If you look at what people were paying then, I mean, if you were getting a good deal in 2021, you're probably paying, over $30 a terahash. If you weren't getting a good deal, we know some of miners. In fact, the miner you purchased recently paid nearly $90 a terahash towards the end of 2021 for an order that was received within 10 days of signing because they paid a premium to receive it. I think they paid like $90 a terahash. And, what miners are paying now, if you've got your discounts, you're paying $14, $15, $16 a terahash at the moment, but it's still not good enough to get that long-term aspirational return. So it's an interesting dynamic. And just one final thing on Bitfarms itself. I mean, obviously, when we spoke to you, over a year ago when you were praising the T21s, then we heard the issues with them, and you've gone replacing. Can you give us an update on the replacement and of those machines coming into the system and what that means to efficiency and he said 95% of machines are in there. Are you expecting a hash rate closer to 20 exahash when it's fully completed?
Yeah, so we've kind of stabilized the T21 mining fleet at this point. We've upgraded several thousand more units, and more or less we're just focused on the normal kind of RMA and servicing of the miners at this point. We've been upgrading them to things like S21 Pros and S21 Pluses. So, again, it's not the S21 XP and the most efficient miner that you can buy out there. We're trying to do a balance here between what the actual costs are and what the performance of the machine is to deliver the best value and return for our shareholders. And, we have improving efficiency. We're up at 19 watts per terahash right now, but really we don't expect the hash rate to grow much more than we are right now. Basically every miner is installed right now. There's normal kind of operational procedures, and then we also have a lot of the miners now are installed in Pennsylvania, where we're doing a lot of curtailment, energy trading, and those sorts of things, which is going to ultimately optimize for cash flow, but doesn't give us necessarily the same amount of uptime that we would have had out of our exahash. So, the big thing here is that we're not really looking to do a big miner purchase. Almost all of our miner growth is basically done. Pretty much every miner has been received. We had 300 miners to receive this week. I didn't actually confirm before this call, but I think that last couple of pallets of miners is in hand now. And so, it's just a matter of plugging in what we've already paid for and maintaining the fleet for as long as possible. And we actually had a chart, a sensitivity table in our Q4 deck, which I think is probably one of the more interesting things that we've published or anyone actually in our industry has published, which was, hey, what's your view on Bitcoin price? What's your view on network hash rate? What's your view on mining economics? And what's your implied gross mining margin, not just now, not just at the end of the year, but through 2026? We did that on a per quarter basis. I haven't seen anyone put out information, that detailed. But the reason why we did that was because there was a lot of concern in Q1 with Bitcoin price being down, 80,000, 75,000, and those kind of ranges, that people were saying this mining business is done. It's like, well, there's two different things here. There's the operations of the machines, which is not done. It's very, it's still very profitable. We had a 43%, direct mining margin in Q1. And we expect that to be generating free cash flow through 2026 pretty conservatively. But it's always been around the challenge of when you buy the machines, what is the price that you're paying for the machines, and what's your expected payback on those machines? And I think people get really kind of obsessed around the mining margins when the focus really should be on the payback and what is your actual return on the dollars invested. I think that's been kind of a distortion for people, but the mining margins are still pretty strong. If you've got a new and efficient fleet, like you should expect to be able to run that through 25. You should expect to be able to run that through 2026, especially if your power cost is effective.
Yeah, thank you.
Yeah, fascinating to listen to all that. And as we go through these Q1 earnings Q&A sessions, definitely a tone shift towards the HPC AI from the Bitcoin mining. So I appreciate you walking through that for us, Ben. One question we did get directly from the subscriber base in relation to Argentina. Can we get an update on the power situation there? I know this is fairly fresh, just occurred, but what is the plan going forward there?
Yeah, so we had an update here in our Q1 filings as a subsequent event. We have been working with the power plant producer, kind of behind the meter at their site for the last several years. And so we're buying power directly from a company called Abanesi. They're one of the largest electricity producers in Argentina. And over the last several years, they've really been ramping up their scale. They've been building out new facilities, and they've taken on a lot of financing to build out those new facilities. Since Milei has come into place, a lot of the economic policies that companies had really built their whole businesses around have completely changed. And so, you have a situation where, underlying costs for businesses have changed, rules and policies have changed, regulatory, policies have changed, people in charge have obviously changed, and companies are doing have to do a bit of an adjustment to adjust to the new normal. On the end of April, they contacted us the last day of April saying, they're having some liquidity issues because one of the latest things that Milei has done this deal with the IMF. And this loan with the IMF effectively cut out most of the spread between the unofficial FX rate called the contengo con liqui rate and the official government exchange rate. And this exchange rate spread has been as high as like 50% or more in previous years, and it has existed for decades at this point. And so companies have relied on this FX spread. They bake it into their business models. It's a fundamental part of daily treasury management and how you manage your liquidity as a business. That changed right at the end of April. And they had a liquidity crunch where all of a sudden they weren't going to be able to make their interest payments. So they advised us on April 30th, hey, we're going to default on our interest payments, but operations are still going to continue as normal. It's not a problem. We're going to go through a renegotiation, and everything is going to continue as normal at all of our sites. And on the 12th of May, so the Monday of this week, we got a notice from Albanese saying, because of the negotiation process that they're going through, the latest development is that they're going to have to turn off their power plants while they're going through negotiation. So we don't have power at the site currently. They've turned off power until the negotiations are done. It's still very early for us at this stage because this all unfolded on Monday. But this is a pretty big deal in Argentina. It's the largest credit default in Argentina history. And this is a company that is one of the largest electricity producers in the country. They've got really big connections in with the government. And, this is kind of a big issue for everyone to get solved. So it's getting a lot of attention. It's getting a lot of focus. But right now, it's a little premature to really know what's going to happen in these negotiations rolling forward. In the meantime, the operation is still there. All of our miners are still there, and we're evaluating all of our options while we're waiting to, see what the developments are here in Argentina. So as of right now, I don't have any more information than that. But that's the background in terms of kind of, what happened here, what led us to here, and, what investors might be able to expect over the next coming weeks and months. When we do have an update in the next coming weeks and months, we'll be providing that update to the market. But as right now, it's too premature to say.
Makes sense. And that's 13% of the portfolio currently, Ben?
Yeah, it's about 12%, 13%. So, it's not a significant driver of our free cash flow. There is some impact there, but it's relatively contained because most of the growth that we've been doing over the last, 12 months or so has really been focused on how do we focus on the US part of our business and how do we grow out that US infrastructure. So it's relatively contained there at that 12%.
In terms of power cost in Argentina, how did that compare to your other sites?
So it's variable in Argentina. It's the only site where we have a lot of variability in the power prices. As of right now, it has been one of our highest power costs in our portfolio. So, while it's 12% of our hash rate, it has one of our higher energy costs and it has one of our least efficient fleets. So we didn't do as much upgrading, of the miners there. So really the impact on our free cash flow is not even, like a 12% pro rata. It's going to be below 10%, forecasted.
Makes sense. Hey, so let's shift the conversation over to the US assets now as well. Anthony and I took a look through this Q1 deck. The renderings of Panther Creek data center or that campus are absolutely phenomenal. We were talking about that before we got going on the call. It looks something out of a Google, Meta, Apple-esque type earnings interview or deck, but let's talk about that a little bit. The renderings themselves, why did we need to get those done? Is that actually what it will look like? Is that just a potential? And how does that kind of relate into the process of developing that Panther Creek asset?
Yeah, I think that's the most exciting thing from our Q1 call, right? We had a slide out there, I think right before we got into the renderings for the site, which is really showing the building blocks of HPC for us as a business. And, we were never going out there last year saying we knew everything in HPC and we're going to get a deal done by the end of the year. And, this is just going to be an easy transition for us. We were very honest about what we didn't know and the kind of resources and the steps that we thought we would need to do in order to actually build out this HPC business the right way. And effectively, there was a couple of things we needed to do. We needed to, one, reduce our focus on the Bitcoin mining growth. So that was getting rid of the megawatts for Bitcoin mining, as we discussed. It was completing the Bitcoin mining that we had already paid for and planned. And it was also getting what we thought were really, really attractive megawatts for HPC and AI. Once we had those, we were able to hire, a couple more people on our team and engage the right advisors externally to help us bring in even more resources. And then that really laid the foundation for what we as a business kind of just needed to really build out this HPC business. And on top of that, what we have right now is a very repeatable, it's a very methodical process that we can go through site by site in our portfolio. And that involves kind of two stages, simplistically, that involves kind of two stages that we outlined there on the slides. One is doing the master site design, engineering, and planning for a site, as well as going out and getting site-specific financing for the HPC development. So at Panther Creek, we already secured the site-specific financing for the first phase of 50 million with the ability to unlock 250 million beyond that for a full 300. And in order to achieve that unlock of the full facility, what we needed to do is we needed to complete the master site design, plan, and engineering process. So that's What is the layout of the site? What is it going to look like? What is the kind of equipment that you're bringing in on site? How are you designing these buildings? Are you designing, a couple of 100 megawatt buildings? Are you designing a couple of 50 megawatt buildings? Are you designing 75 megawatt buildings? Are you designing it for 80%, liquid cooling and 20% air cooling? Or like all of these different kind of engineering questions and design questions that we have to work through is the key milestone that we need to have to unlock the full facility. And what you see there in the renderings is something that's coming out of that process. It's what's coming out of the design phases of these sites. So it's coming out of the 3D modeling of the facilities. And really, this is one of, I think, 3 different designs that we're currently evaluating. So we've got more renders like this because what we're doing is a lot of these designs are specific to different data center engineering firms, different data center kind of modular suppliers. And what we're doing here is we're trying to get as much information, as much designs, done as possible so we can really ramp up that learning curve and that we don't just put all of our eggs in one basket and say, hey, we're just going to go with this engineering firm or this manufacturer of modular data center infrastructure and call it a day. This business is too important for us as a company to just trust somebody, right? And put all of our eggs in their basket. So we're doing this with multiple different companies right now. And so, we are designing this facility to target a company like a Google, like an Amazon, like an Oracle or something like that. And so, it's going to have to meet their requirements. It's going to have to meet their high quality. And what we're doing here is something that not only we're doing at Panther Creek, but as soon as we're done with it at Panther Creek and we've unlocked this facility, we're going to be able to leverage everything that we learned here at the Panther Creek facility, and we're going to be able to replicate this across the other sites in our portfolio. And that's a really important part of this process because, once we're already, working towards the construction, the development of these sites, we have to start having a marketing exercise with not just the Panther Creek site, but with all the other sites in our portfolio. So we've had these initial conversations with potential customers, specifically around Panther Creek and Scrubgrass, as well as actually a little bit on Washington site. But what we really want is we want to get our portfolio to a position where we can not just market one site at a time, but market a whole pipeline of sites at a time. What are we going to have available? When are we going to have it available? What does 2026 look like? What does 2027 look like? What does 2028 look like? Which one of these sites, according to which one of these timelines, matches your specific needs as a customer? And that's going to help us ramp up the process here quite rapidly. So it's been a really exciting time over here at Bitfarms. I think we're really excited about the progress that we've made. We just closed in on the Stronghold transaction just about 2 months ago on March 14th. So we've gotten a lot done in that time since then. And, we're really ramping up our efforts here now that the Bitcoin mining growth box is effectively ticked.
So Panther Creek effectively becomes your model to show you can deliver this type of service to potential clients. And once that happens, then it's a case of you've got 3 other sites with Scrubgrass, Sharon and Washington State all coming online in the near future as well. This 1 gigawatt of effective pipeline of power that you have. Obviously, the big question is, yes, you've got 300 million potentially from the Macquarie investment there. I mean, that's that's nowhere near enough to cover what with that level of pipeline there. I mean, how are you going to be able to unlock further funding to even get the size of Panther Creek to where that needs to be?
Yeah, it's a great question because 300 million definitely isn't enough to build out Panther Creek and have hundreds of megawatts of full data centers.
Yeah, not that quality you're indicating there. We've seen some other miners using this like a hybrid approach to building HPC hosting data centers, but you've articulated there that the customers you're looking at, they want the sort of like near top end type facilities, and they're not going to come anywhere near the price that maybe the likes of TeraWulf and Core Scientific are thinking of paying.
So there's 2 different ways that we can go forward on Panther Creek. The first path is that we can build out the entire infrastructure and the entire building for the first building, and we can have spare capital to invest in the remaining megawatts and the remaining kind of land infrastructure that we need to build out on site. Or we can build out all of the electrical and all of the land infrastructure for all of the megawatts. And we'd have a little bit of spare capital towards contributing towards the first building. And really what's going to make that decision ultimately is going to be the customer conversations that we're ramping up. And there's kind of two different ways to approach this. The first is you can say, hey, we're looking for the customers who are very focused on timeline to execution and less focused on scale, right? So these are the companies that would be more like a CoreWeave, for example, that are, hey, we've already committed to all these GPU purchases. We really want to get these plugged in as fast as possible. And in those sort of situations, we can flex that capital to deliver that first building and those first contracted revenues as fast as possible. But in the scenario where we're actually working with, a major hyperscaler customer, somebody who wants, upwards of the 500 megawatts that we have available at that site over the next couple of years, they're actually going to not want us to focus on the first building. They're going to want us to focus on making that land fully developed and fully available for them to develop, right? And so it really is going to be dependent on what is coming out of these customer conversations, what's the best opportunity for us and the customers, and what are the associated timelines with that. Now, if we are going down that first route where we're just building out the first building, and we've made all of that significant progress on the building, on the customer acquisition for that, it's so much easier and cheaper to get the capital for the remaining buildings at that point, right? So we didn't want to go out there and say, look, we're going to raise, more money than we need, because when we develop and when we show progress and when we execute, the cost of capital is only going to go lower. And in this space, we are not just competing on timeline, we're competing on cost of capital. And so we're just trying to target the amount of money that we need to unlock this real critical first phase. And then as we develop on the further phases, we'll be seeking out, additional funding at what should be increasingly lower cost of capital.
And obviously, once discussions get to a certain point with potential customers, the ability to unlock further capital once you're in them sort of agreement process becomes probably that little bit more easier, because
Yes.
the big banks will want to invest in this type of business because of the predictability of the actual business itself, the revenues, and understanding the costs. Whereas the Bitcoin mining business is totally unpredictable, hence why miners pay a premium in terms of cost of capital on that type of business.
Yeah, it's really not possible to finance the Bitcoin mining business with traditional financing instruments, which is why the industry's relied so heavily on equity. But when you're looking at HPC infrastructure, it's a completely different game, and all of this infrastructure is financeable. And so we need to be matching the infrastructure and the objectives here with the right cost of capital in order for us to be competitive. I would think that, one of the big drivers here for this industry, especially as the public miners transition off into HPC, one of the big changes here is going to be how these companies raise capital, right? And what is a good cost of capital? Because the ATM programs that people have been running, for several years don't make sense for HPC. They don't make sense for this kind of infrastructure development. It's going to be a lot more traditional debt investments that is going to be what really, really, I think, drives these projects forwards and finances them. So the industry's changing. These companies are changing. We're all changing for a very good reason. There's just like tremendous opportunity here for shareholders to pivot from, the Bitcoin mining business model to the HPC.
And just ask one question: when you're, I suppose you've not really got to maybe the negotiation stage yet with the big clients, but when you're dealing with, say, the likes of an Apple or a Meta or an Amazon, the power and the size of those companies, I would assume they'd be trying to squeeze margins as much as they possibly could. Whereas maybe is there more opportunity to get better margins from say, not the hyperscalers, but maybe a group of clients underneath that, maybe like the CoreWeaves of the world. How do you see that sort of that sort of I'm trying to think of the word. How do you see that
That
phase?
dynamic playing out.
The dynamics of
Yeah.
that. Yeah, sorry.
It's a balancing act, right? Because obviously risk needs to match the reward, right? And so if you're taking on more reputable counterparties, you should expect to have lower reward to match the lower risk, right? But at the same time, that lower risk also drives a lower cost of capital, right? And so there is a balancing act here between the amount of risk that you're taking on either the counterparty for the customer side and the risk of the rate of your cost of capital that you're raising to build out that infrastructure. So there's a little bit of a balancing act to put into place there. They certainly do have more negotiating power than a small enterprise would, but at the same time, if their portfolio is really lacking and they have the market demand for the power and they've already made the allocations into the GPU and the compute infrastructure, then the relative cost of the infrastructure is so much less than what the compute is and what the market opportunity is that there may not be a need to really force a squeeze through because they have their own squeeze on their own supply chain, on their own timelines that they really need to accommodate. And that's where this balancing act kind of comes into place. The really fascinating thing here that I think a lot of people are asking in the market is, why are so many Bitcoin miners doing this, and why do they think that they can compete with an HPC data center company? And I think, for the most part, we're not looking to compete with traditional HPC data center companies. We're looking to service them. And the reason the reason why there's an opportunity here is kind of twofold. One, there's an opportunity on the energy portfolio side, which I'll focus on. And then two, there's an opportunity here on the investor side. On the energy portfolio side, you look around at the data center companies that really dominate this market, the Equinoxes, the Digital Realties, the Iron Mountains, those kind of companies. They're really largely defined by having very large portfolios of really small sites. So, this might be, they might have 3 sites in Manhattan, that are 1 megawatt, 2 megawatts apiece. They might have a site on Bay Street. They might have something in downtown LA, in downtown Dallas. And the whole business model was structured on, how do I get as close as physically possible to the end consumer of this data? But that meant that they're trading location for scale and cost. If you now want to build out AI infrastructure and the AI infrastructure needs scale, these traditional data center portfolios generally don't have it. They're generally have been so focused on these really tiny sites, they don't have a whole bunch of hundreds of megawatt sites. The only data center companies that really have these large scale sites are hyperscalers and Bitcoin miners. And it's because the Bitcoin miners who have been so focused on scale over the last couple of years that we now have the one thing that these traditional data center companies don't, which is the power. And it's the power right now. It's the power applications in the queue to continue to scale up and to continue to grow, which is really representing the opportunity. Things like, do you know how to do the engineering? Do you know how to do the construction of the site? All of these different things can be solved with the right strategic partners, right? But if you don't have the power, there's nothing to do. And so, this is the real opportunity here, and why these HPC companies, or why Bitcoin miners have a leg up here and a space to compete here on the HPC business. It's because we've been investing in these assets, which, there was no demand for in the traditional data center world when we started investing in them. But now it seems to be the defining characteristic of compute rolling forward is scale. And so that's a really interesting thing, I think, on the energy side. And actually, one more thing on the Bitcoin mining side is Bitcoin miners tend to be a lot more scrappy. We tend to be, companies who can think outside the box, who want to challenge the norms, who want to we're used to technology that changes really, really quickly. And we're used to finding ways to do things for less money. And a traditional data center business, it doesn't think that way. They've always built their data centers this way. They always want to build their data centers this way. And they're so stuck in that mentality, it's really hard for them to pivot. It's really hard for them to think about how do you build something that's modular, for instance. The containerized data centers that you see now, even for more traditional data centers, like nobody did that before Bitcoin miners threw Bitcoin miners in containers, right? It was like the Bitcoin mining industry who proved out that you can run compute in a CCAN. And so, it's these kind of things where there probably is going to be an advantage for Bitcoin miners for us to be able to think differently, to be able to try and think about how we can build something in a different way to collapse timelines and reduce costs in a way that traditional data center business just aren't geared that way.
I mean, obviously, you've got the 4 sites there, the 1 gigawatt. I mean, that's an immense amount to build there. You talked about the fact there's not enough large sites in the US, and only the hyperscalers and the Bitcoin miners have got them. Does that mean would you start to expect to see a premium for these sites that become available with the gap in what's being utilized for HPC currently and the demand that's required over the next 3, 4, 5 years?
Definitely compared to where Bitcoin miners
where
are
we are
valued today, absolutely,
yes.
There's a massive premium here. And really, this is going to be an execution story, right? Are you not only able to take these assets that you have, but are you actually able to execute on them? Are you able to convert them? Are you able to develop them if it's a brand new development? Are you able to work with the correct partners and make the right engineering choices and raise the right capital at the right prices and at the right times? This is going to be an execution story over the next 3 years. And so, the companies that are going to be able to do that, they are going to justify a huge premium. I think right now, the reason why maybe there's still a bit of a gap between where things kind of are probably going and where they are today is because it's hard to know which one of these companies is going to be successful in execution. And so there's a discount applied until that's proven. I think as companies continue to prove out their capabilities, those sort of premiums are going to start to come into these companies and they're going to start to be reflected in share price. But I think there's a bit of an execution and a show me story here. And that kind of ties in really well with the investor piece here, because look at where the Bitcoin mining industry trades. Like as a publicly traded Bitcoin mining company, most of them kind of trade on this multiple that's maybe like a 3 to 5 times adjusted EBITDA. Some companies trade a little bit less. I think Bitfarms is closer to a 2, and I think that reflects that our Bitcoin mining business is not even being properly valued right now. But then you look at what the opportunity is on the data center side, and the data center companies trade at closer to like 20 to 30 times. And so there's no guarantee that you're going to get to the 20 or 30 multiple, but think about the relative distance between a 3 to 5 and a 20 to 30. Like for us, when we're trading closer to 2, that represents between a 10 to 15 increase in valuation. Like not 10 to 15%, 10 to 15 times. So it's a really, really big gap. And it starts to say, well, wow, if I can unlock this huge valuation increase by converting over megawatts and converting over assets, and it can be reflected anywhere close to that, even if it's at a 10x multiple, and that is going to deliver significantly more value for shareholders for every dollar invested than Bitcoin mining will. And so, there's a really, really strong economic incentive for these Bitcoin mining companies to take HPC and AI development seriously and really focus all of their efforts on it. Because even if you grew your Bitcoin mining business significantly, there's no indication of how you're actually going to be able to increase your multiple beyond that 3 to 5x range. But if I can convert it off into HPC, I'm looking at targeting a significantly higher multiple than I would ever be able to deliver with Bitcoin mining.
When would you expect, say for instance, you managed to acquire a client and you maybe use Panther Creek as a starting point for delivering your HPC business strategy. When would you expect the market to start giving Bitfarms that premium that like you just highlighted, the fact that other companies, even CoreWeave, which has just recently IPO'd, the value of that company is going up, considerably now. And they've just announced their first quarter results, and they're getting quite a nice multiple on their earnings. And yet the miners, even those miners who've managed to acquire contracts, are not getting anything at the moment. Is it a case of you've got to wait to see the revenues coming through to see if you can deliver before the market sort of appreciates that and then gives you that multiple? And to do that, once you get that, it unlocks a lot of more doors in terms of the ability to raise more finance. But it's like, I'm asking the question: when's it? We talk about it, but when's it likely to happen?
Yeah. I think the more progress you can show, and the more success that you can show, the higher these companies are going to go, because everything that you can show that's showing progress is going to start reducing the risk, right? And reducing the uncertainty. And I think right now we've got a lot of uncertainty priced in, right? But the more that you can develop, the more that you can show, whether that's significant progress on the development, whether that's signed, major contracts or what have you, whatever those kind of development milestones that you can achieve are hit, I think that's going to start reducing the uncertainty and then start inching you closer to those premiums. I think most of the development timelines for companies is probably more on a 2026 timeframe. I think a lot of companies are trying to target something by the end of 2025, whether they have something in place or not. But 2026 is probably a more realistic timeframe for most companies to have HPC revenue. Now, it doesn't mean that they can't demonstrate a signal to the market well in advance of having, HPC revenues actually hitting the bottom line. But, I just kind of outlined that there's a couple of steps there, I think that people are going to need to achieve. And I think the other thing, that might be interesting is that there's been a really strong change in the market since about November or December of last year. I think there's a line that you can kind of draw in the sand around December 9th or December 10th. If you remember back to that time, I think every Bitcoin miner is down since that point in time. And the situation in the previous weeks leading up to that was just a ton of convertible financings, right? Basically every single company was trying to go out there and raise hundreds of millions of dollars. They were all trying to do it for 0%. They were all trying to buy a bunch of Bitcoin with it or do whatever you want with it. And what happens in a convertible financing is, everyone wants to say, hey, we're getting long-only investors and fundamental investors. The reality is that most of it is hedge funds, and most of them are doing some sort of an arb trade. And so, the lower you go on the interest rate on the coupon, the more they need to hedge out their bet and the more they need to short that stock. And so, while targeting a 0% coupon rate is really great for, hey, we don't have any debt service, it's really a low number to advertise out to retail investors, especially. The reality is that in order to achieve those 0%, you had to trade off somewhere. There is no free lunch, right? And the alternative, or what happens on the side, is that the short interest just goes up tremendously. And so, at the end of November, at the end of December, short interest across all the industry just went through the roof, and it still remains through the roof. And so you had a combination of things happening. For the companies who did convertibles, often there weren't enough shares to borrow to go short. And so you started actually looking at all the other companies in the industry to borrow who were trading on a similar thing. So for companies like Bitfarms, who didn't do a convertible, we got shorted because everyone else did a convertible, right? And there was a number of companies in the industry, like Bitfarms, who didn't do a convertible, whose short interest spiked because everyone else did a convertible. And part of that is maybe people are expecting us to do a convertible, so they're pre-pricing it in. But I think really the big driver there is when there's not enough available shares to borrow, you're starting to look for proxies where you can get more shares, you get more of the hedge in place, and maybe you can do it more cost effectively. That got in place around December 9th or 10th. And then in January, you started having a sequence of domino events, right? And you had the DeepSeek news, and you had Liberation Day, and you had all this, fear and uncertainty in the market. And every time you take a step down, the hedge funds increase their short position. And so it just became a domino effect across the entire industry. I think, now we're in a position where markets are starting to stabilize. The short interest really hasn't gone down so much. But at some point, there should be short squeezes in this industry because these shorts were put in place for specific reasons. And in a lot of instances, like in the instance of Bitfarms, it was not put in place, at least we don't believe it was put in place because of anything that we did operationally. We believe it was put in place because of, what was happening in the industry overall, right? Not because of what was happening within Bitfarms specifically. So, there's a lot of pressure there. And I think once we move past that, and once there is some demonstration here of the progress that we've made, and we've made tremendous progress, especially at Bitfarms with the multiple transactions we closed in Q1, securing the big financing in April, doing all of this fantastic work on the design and the site map engineering, the planning and the evaluation of the manufacturers. Eventually, that's going to hit an inflection point, is what we're expecting, or what we believe is going to happen. But when, hard to say. But those are the kind of catalysts, and I think the kind of driving forces in the market that maybe your audience, might not be so aware of.
That's a great explanation, Ben, of the inner workings there. I really appreciated that. I know we're slightly over time here. We did have one question about the Bitcoin One program. Although miners now may be shifting away from the traditional mining, obviously Bitcoin on balance sheet and Bitcoin strategy within corporations is becoming mainstream. So if you have time, we'd love an update on Bitcoin One. Then I'll let you close out and we'll let you get back to your day here.
Yeah, well, we had implemented the Bitcoin One program in Q1. It was built off the successes that we had in 2024. And Bitcoin One is now a much more comprehensive program. So we're doing treasury management, and we're trying to amplify our returns on our Bitcoin. The situation now, I think, is a little bit maybe unclear to investors because they see us selling off a lot of our Bitcoin. But a lot of time when we're marking a Bitcoin as sold, it's not necessarily sold for cash. Sometimes it's sold to be funded into the Bitcoin One program and to apply leverage to that Bitcoin. But the way that the accounting treatment works, we can't recognize that as a Bitcoin on our balance sheet anymore. We have to recognize it separately. For us, we really want to focus on how do we grow our Bitcoin on our balance sheet? How do we get more Bitcoin for less money? And also, how do we maximize the value of the Bitcoins that we're selling, right? Because we are still selling Bitcoin to fund operations. We're going to continue to sell Bitcoin to fund our operations, but we're trying to do a balancing act between what we have to sell and having that exposure to the rising Bitcoin prices that we still see happening in 2025. We always forecasted, and we forecasted this for 2 years, the exact same kind of investment thesis, which has been underpinning, all of our operational decisions over the last couple of years. And it was in 2023, Bitcoin prices is going to rally. We need to buy the miners at the lows going into the halvings. We need to get ready for the Bitcoin mining bull run and the Bitcoin price bull run that we really expected in 2025. Like we knew it was going to do, or we expected it to do well in 2024, but we really thought the price was going to do well in 2025. And, now we're in a position here where confidence is returning to the market. Sentiment is really shifting in favor of Bitcoin. You've got this massive amount of Bitcoin treasury companies which are emerging. I mean, when we started putting Bitcoin on our balance sheet, I think we were one of like 10 companies who did this worldwide. Now there's 100. It's going to be 200 by the end of the year. People are raising billions of dollars. I mean, I can't remember which company this was that came out just like a couple of weeks ago, and they were going to raise $100 million, or they went to the market to raise in a minute. They raised 712 overnight. And so the demand for these kind of vehicles is really driving a lot of Bitcoin accumulation strategies. It's really driving a lot of this institutional adoption. And where are they going to get the Bitcoins? Saylor has a 5% target. He wants to have 5% of the Bitcoin. I think the number thrown around on the U.S. Strategic Bitcoin Reserve is 5%. I think a bunch of other companies are saying we want 5%. Well, 95% of the Bitcoins that will ever be mined have already been mined. There's 5% remaining over the next 120 odd years. Where are you going to get all those 5%? And what's going to happen to the price with all the money flowing into all these companies specifically just to buy Bitcoin at any price, right? It really should be a big bullish market on Bitcoin price. And we want to make sure that, we have the exposure in our portfolio to outperform Bitcoin as opposed to just sit there and ride the wave up and down. So, we haven't been running the program in Q1, for more than a couple of weeks, which is why, there's not a ton of information on it. But, we'll be providing more information on the success of that program as it rolls forward. And we think it's one of our key pieces here on the Bitcoin leverage side. We're still a Bitcoin mining company. Nearly every dollar that we generate in revenue is still in Bitcoin. I think more than 50% of our total cash and Bitcoin liquidity is in Bitcoin. And so it still remains a very, very key part of our business rolling forward. But we're really looking at the Bitcoin as kind of twofold. One, we have the Bitcoin mining, which is the low capex or almost zero capex free cash flow foundation to power the business, to operate the business, and help us focus on the HPC development. But we're also looking at it as treasury. And how do we actually, gain an advantage here? And how do we maybe reduce our own cost of capital in HPC development in the future? And, Bitcoin is a fantastic collateral asset. We can borrow against Bitcoin for rates, lower than you can borrow against almost any other asset on the planet. You can do so with total flexibility. And, this could be a potential way for us to, as we continue to, build out our HPC business. I don't think Bitcoin necessarily goes away. The Bitcoin mining will get less relevant, and the Bitcoin will become a treasury asset. It will become a financing vehicle. It will become one of those things where it's kind of the Bitcoin meme of hone your craft and save in Bitcoin, So, our craft is building and operating electrical infrastructure. That doesn't mean that's necessarily the best way that mining Bitcoin is necessarily the best way for us to accumulate Bitcoin. What we do best is building and operating that electrical infrastructure. And so let's focus on that, and let's try and save in Bitcoin. And let's try and use our Bitcoin to do what we do best better.
That's awesome.
Just one very quick question, Ben, before we let you wrap up on some of the highlights going forward. You mentioned the shorts there, which was obviously a concern, and it's great to get that level of understanding, because I think a lot of people, they see these phrases talked about and they don't really, understand. The retail investors out there don't fully understand it. But, in terms of the effects on share prices, we saw a lot of share prices drop. I think, averaging about 50% in the North American public miners over that period. Your share price dropped below $1 for quite considerable time. We've had some miners getting notifications from the SEC. Were you close to receiving notifications? Is it a concern for Bitfarms at the moment?
So we didn't receive any notification. The trigger for that is 30 days under $1 is what triggers that notification. And I don't know exactly how many days we were under $1, but it wasn't 30. And we didn't receive that notification. The notification is pretty standard. If you do receive it, you receive it, you've got 6 months to address it, and there's an almost guaranteed extension of an additional 6 months. So, for any company that does receive that, they effectively have 12 months to deal with it. For us, we think that we strongly believe we're just incredibly undervalued for our existing business, let alone for all the amazing progress that we're making on the HPC side. And we think that a lot of the positive sentiment is returning to the market. So it's not a concern for us, right now. Who knows what the future holds? But for us, we're really, really focused on growing the HPC business and delivering the maximum amount of value that we can for shareholders through that conversion that I talked about. And things like, an SEC notice, which, we're not in the condition to receive right now, nor would we be for the foreseeable future. It's not really on our radar right now.
Sure. This was an excellent discussion. I really, really enjoyed this one, Ben. I know we've taken a few extra minutes here. We want to give you an opportunity to wrap up, and thank you so much for your time today.
Well, it's always a pleasure to be on, guys. And I think the big thing here is, to just comment that we're still in a bit of a transition period as a company, but we've already accomplished a tremendous amount. I've almost been in the seat now 11 months. This company's completely transformed over the last year. We've gone from a company that was really focused on developing our international Bitcoin mining business, and we had almost nothing in the United States, to a company that is really, really focused on the United States, who has scaled down their international operation, who has stopped focus and effort and investment into further Bitcoin mining, and is going full speed towards this HPC business. We've completely reorganized the management team. We've completely organized our operational teams. We've fixed most of the T21, underperformance issues. We've kind of stabilized and optimized our mining operations. And now we're just sitting here with, all the assets, all the people, all the right advisors and external teams in place in order to really focus on execution and delivering this HPC business. And it's a super exciting time over here. Everyone is really, really energized to move forward. We all see where this is going, and we're just incredibly excited to be building it.
Yeah, just incredible, Ben, listening to the progress there over the past 11 months. We can't wait to see where you're at in the next 11 months. And a big congratulations on the quarter and all the transformation that's really happened at Bitfarms. If you guys have any additional questions, leave them in the comment section below. Hit the like button. Feel free to subscribe. Ben, we'll see you in Las Vegas and look forward to it.